Now to the final session of the conference, Boutique Managers Advantage in Generating Alpha. First, I would like to invite Rajesh Kothari. Rajesh Kothari is founder of Alpha Accurate Advisors, which has been a leading firm in India since 15 years. Over these 15 years, his investors have multiplied money 15 times in these 15 years. Rajesh has 27 years of experience in the Indian equity markets, and he was prior a fund manager at DSP Mutual Fund. Rajesh. Next, I would like to invite Mr. Sandeep Daga. He's the MD and CIO at Nine Rivers Capital. He has 32 years of work experience. Prior to public markets, he was into private equity, worked with ICICI Ventures and Frontline Ventures. He's an electronics engineer and an MBA from NMIM. Sandeep, please. Next, I would like to invite Mr. Manish Bhandari. He's the CEO and portfolio manager at Valum Capital. He has 25 years of experience in the Indian markets and used to be a portfolio manager at ING Investment Management. Next, I would like to invite Vaibhav Sanghvi. He's the CEO at ASK Hedge Solutions. He will discuss his long-short strategy. He was with Avendus Capital Public Markets earlier. Vaibhav, please. And to moderate the session, we have Kishore Bagri, very dynamic, very versatile, wears multiple hats. He used to be a fund manager at ING, then now he's a wealth manager. He used to be on the board, used to be a board member at the CFA Society. And he has been whole and soul of the CFA Research Challenge.
So very good evening to all of you. The concluding session of the day. You must have all already got tired by a couple of very, very high-hitting sessions. So I'd like to grab your attention by trying to do a panel which is slightly differentiated to what you might have come across traditionally. The differentiation was already initiated by Kunal. I mean, typically in most of the panels you must have seen the announcer introduces the moderator and then the moderator announces the panelist and the bio of that. But Kunal stole the thunder. So he started the differentiator right from the start. Now just for creating some more, so I have the red diary in my hand, so if that is of any indication. Okay, so as the topic goes, the boutique managers' advantages in generating alpha. So three keywords that I can kind of gather here. Boutique, which kind of is well established, and we'll try to understand from the panelists as to what actually is defined as boutique or mainstream for that matter. Advantages, if really there are any. And the alpha, which how sustainable it is to generate with the kind of approach that most of the boutique managers kind of follow. So just to kind of summarize my thoughts, from a money management and a manager's point of view, my basic sense is the key differentiator or the path to generate consistent alpha could be because of the skill. So 3S as I have kind of thought in my head. So skill, strategy, size, again, it is debatable. A lot of people think size is an advantage. A lot of people who are big enough want to quash that thought. And then the regulatory framework or flexibility that different platforms provide from a regulation point of view, whether that gives any kind of advantage or not. So to start to jump in, so let's maybe Sandeep, if I can start with you. So your basic thoughts on these four parameters, and we are looking to hear you to start with as a generic thought rather than your specific approach here. So more of a generic thought on boutiques and these kind of four parameters that I just kind of thought in my head whether they are the real differentiator of the alpha that gets generated.
Good evening, everybody. Uh, this is the last session, so please bear with us. You've been here whole day. So Kishore, you know, I would say that what makes us boutique, if you want to call us boutique, is that we chose to become that way because we thought that there is, at least in our case, I thought that there is a case to apply the private equity approach. I had a 1.5 decades of private equity investing career, so that approach can be applied to small cap investing. And that led me to set up the PMS that we run. And now this is 13th year in the running. And I think we've been able to at least satisfy our clients by generating superior alpha for them over this long period. The team that we have also, I think, is connected with the same cause of long-term investing. We look at the long term, and again, coming from that private equity leanings that we have, we look at 5 years as an investment horizon in any stock that we invest in. So that also kind of, when you speak about skills, people who are passionate about long-term investing would love to work with us. We do not have, the luxury to celebrate every day that aaj mera stock 10 taka upar gaya. We have to remain patient. It's a pretty boring style of investment that we do. So people who connect with that kind of a strategy love to work with us, and we've been fortunate to kind of have a team which has been with us, and we've stayed together for very long periods of time.
But as a generic boutique managers, if you talk in general, I mean, you are talking about your individual approach per se, which we will come to later. But in a general sense, the boutique space per se, out
So
of
that's
these
what
skill, strategy, size, regulatory framework, do you
each
think
one,
these four kind of
so for me, that
encapsulate?
every boutique manager brings a certain style and a certain niche in terms of their approach to investing, which helps generating long-term alpha. Now, this is my view that boutiques, the moment you call us boutique, it is basically, that means we can't manage huge amounts of money which mutual funds manage, because then we will have to mimic some things that other firms are doing. You cannot stay, for example, I can't invest in small caps if I say that I'm managing $2 billion. I mean, that's not what my strategy is not going to work. I know that. So that's how each manager would have their own right sizing of assets, what they can manage before they have to diversify or move away from their core strategy and kind of become more mainstream, as you say. So for us, it's been this journey, and likewise, I'm sure everybody will have views to share.
So, out of the panelists, we have Manish and Rajesh, who have managed mainstream funds for a long period of time, and then have moved to boutique style of managing as their own business and doing the investment also on their own, being the front runner of the strategy and the implementation. So, Manish, if you would like to add, again, in the same vein, without too much going into deep in terms of your approach per se, which we will revisit later, but in a generic sense, coming from a mainstream managing and then looking at a boutique style of managing with these four parameters of skill, strategy, size, and regulatory framework, how would you encapsulate, though it is not a versus a mainstream, but vis-a-vis, there would be some differentiator or distinguisher, right?
So difficult for me to tell you that how one would distinguish between one manager versus others, or the mutual funds, which are the larger cousins or so. But yeah, what is investment? Investment is expression of yourself. And when you are a more and more boutique, what you are doing is you are expressing yourself. And as Sandeep was telling, is you may not have a luxury of to be all over the places. So by this nature, Berkshire Hathaway is a boutique. By the same construct, even a Seth Kalman is a boutique, because you have a very distinct style of managing of funds. So what a boutique would do is he'll not be all over the places, because every cycle will not be for you. Every style will not be for you. You will be specifically made for certain styles, and that's what makes you boutique. So the deconstruction of the boutique is not just on the investment side, is also for you to communicate to your clients. that how we would manage this fund, and you would stay on the course on managing that fund, and client has to, whomsoever is a provider of the capital, would appreciate that this under certain circumstances, these are the things what you would do, and these are the certain circumstances you won't be able to do those things. So this what makes it a boutique, which may not be a possibility in a larger platforms, which are multiplexes.
So the
themselves.
mainstream, so to say.
Absolutely, yeah, yeah.
Rajesh, would you like to share the thoughts on the same?
Yeah, thank you. Good afternoon, friends. So if you ask my way of, what is the meaning of boutique? Boutique means, see, please understand, every investor has a different risk reward, correct? And if you are a boutique firm, you have your own style. And you will onboard the client if and only if your investment style of creating alpha generation on the long-term basis, if you think is also matching and mirroring the investor's risk reward mandate. So you have a discretion to select or not to select. And for that matter, even client, you explain, so even client has a discretion to select or do not select. Am I right? So the boutique means, that's why the founder is a fund manager. That's the key differentiation between boutiques and others. While all managers are good, I keep saying, but they do change their jobs. India is a hot market. When an investor who is for example, matches our style, the biggest comfort what he draws for any boutique manager is that the face is not going to change, good or bad, but this is the face, am I right? And that is something very, very important because it is like restaurant business, am I right? The chef changes, the taste changes. Here, that's not the risk. It's a zero risk of changing guard. That's basically boutique because the entire organization has a particular culture of investing which is basically made is a customization way. And if and only if the investor's risk return objective can be catered by that firm, then only you onboard. So if it is a Mexican food and investor, the customer also likes the Mexican food, then it is welcome, correct? If he likes pizza, then this is not for him. Now that's a big difference because the key objective what we all forget is not being boutique or not being generic or mass, but what investor wants. So investor is at the centric of the entire premises. So that's how we look at boutique. And size is no constraint. I mean, boutique can be $1 billion, it can be $10 billion, it can be $100 billion, provided that manager thinks that his style can keep delivering alpha, whatever the size. Okay.
So three of the panelists are typical long-only investors in this setup. Vaibhav is a differentiator in terms of the panel as well, where he is more into long short. So Vaibhav, would you like to share your thoughts around this particular argument?
Yeah, I think, first of all, good evening to everyone. When we talk about boutique, and I think Manish and Rajesh did mention about that, boutique is not subject to the size, provided your underlying strategy at a higher scale continues to deliver that kind of objective which is desired. From our perspective, we have been truly, in essence, a boutique purely because in India, we are close to about 99% of the market, which is a long-only market, and a very extremely small portion who kind of caters to the whole long-short as a philosophy. Globally, things are quite different in that sense. Of course, not to the proportion of a mainstream, but close to about, say, 5 to 7% of the global wealth is under something called a long-short kind of strategies. So in India, as a context, I think we are fairly boutique. Now, that is from a strategy perspective. And to your question, one more is in terms of the skills, which I do think is one of those elements which kind of actually define the success, especially into the long short as a philosophy. Why do I say so is purely because we've all been cultivated right from the beginning that buy and hold, great money, you will accumulate. And of course it does, no doubt about it, and the returns have been phenomenal. But thinking about markets, thinking about an opportunity on both the direction of the market, you need a completely different mindset. To cultivate that kind of mindset, actually it needs huge amount of experience within that field to kind of master that kind of, strategies. So I would say that in this case, the strategy itself, which is a long shot, and two, the skills which needs to manage those kind of strategy is fairly boutique.
So what I gather from every one of you having expressed that it's a combination of skill of the founder slash the fund manager, the strategy that you have in terms of style or a particular niche, which is consistent and does not change as per the market cycle, even if you have to go through a bad patch of performance. And this is supported primarily by the client selection that you do, because you board the client, align to the client in the similar manner, so that those kind of issues don't keep happening with the client, which typically happens in a mainstream where a bad patch of performance is very difficult, or the investment guy and the sales guy are just busy defending the performance rather than articulating why is it happening, or this is expected in a particular phase of the market. So that would be a fair kind of inference. Now, how in all these, the flexibility of regulation provide an advantage or not so much of an advantage? Any thoughts on that? And not particularly for your style, but in general. Because as we know, if you are managing a fund on a PMS platform, you don't have a single stock limit of 10% as compared to, let's say, a mainstream fund. So that gives you a flexibility. Whether you choose to use that or not is your style. But that gives you a flexibility. Similarly, there could be other aspects of regulation. So is those kind of regulatory differentiators or flexibilities do give you an advantage, or they are not much of an advantage?
Kishore, there are advantages and there are disadvantages. So the advantage for a PMS as a structure is that you can, as you rightly said, you can decide what weights you want. You can go overweight on sectors, stocks. There are no regulations that say that there is a limit to which you can, you need to own and you can't. You can customize the strategies even for your clients, specific clients, which is not possible when you run a larger mutual fund. It's all the same for everybody. You don't have the, you can even, you don't have the compulsion to run model portfolios. You can customize portfolios. The disadvantage is that possibly when it comes to tax friendliness, the treatment of how PMSs are charged to the manager's fees are not allowed to be expensed out because this is not pooled capital and it is not unitized. So unlike mutual funds, so there is that is a bit of a disadvantage which the industry right now is carrying and representing, that this anomaly should be addressed. So yeah, so it's a mixed bag actually. For example, when a mutual fund say does a short-term trade and makes money, the unit holder doesn't suffer because unit holder still holds for the long term. If a PMS tries to do that, the client ends up paying short-term capital gains then and there. So there are both advantages as well as disadvantages, but in overall, it is about you have the ability, basis your strategy to structure the product offering. That is not always possible with larger mutual fund platforms.
Any diverging views, Manish, or want to add into what Mr. Sandeep was just mentioning?
No, I would maybe echo it louder that there is too much of regulatory advantage to the mutual funds versus what a PMS industry has. But there's one spot which will blur these, and that is
I think you can.
Sure. So there's one spot where, so the first thing what a PMS has or boutique has is the zeal of the founders, which is unmatched. I can tell you that it's unmatched. So second thing, area where the PMS would have a lot more advantage versus the bigger cousins is the GIFT City, where they don't have any regulatory advantage. Everyone is on the same platform, and that's the business of skill. So anyone would like to be in the business of skill, not on the regulatory advantages one has versus another else. But yes, at the moment, at least when you operate in India, you have a disadvantage in the process.
So you are of the camp that the boutiques are regulatorily at a more disadvantage rather than an advantage.
Oh, absolutely.
And
Absolutely.
Sandeep has a view that both are kind of pros and cons and set off
Yeah.
and how you kind of operate.
Yeah, absolutely.
Rajesh, any?
No, I think, we need to understand the birth of PMS industry in India. Why PMS came? First of all, mutual funds are always there.
Yes.
PMS came because to offer personalized portfolio management. That's what the customization was the foundation of the PMS industry, the concept of PMS, correct? The unfortunate part is, while one end it offers customization, on the other end, because there is no level playing field, what Manish is trying to convey is that, which is nothing to do with, say, regulator, but from the income tax perspective, the taxation perspective, the level playing field has not yet come for PMS industry, unlike the mutual fund industry. So if the mutual fund, a particular fund, for example, has a churn rate of 300%, it's okay. However, mutual fund, when was introduced, original concept of mutual fund is a long-term investing. But if a fund is 300% churn, it is okay.
Long-term investing for the client or for the fund manager?
Correct, correct. Whereas in PMS, the same product, if it is a churn, then it is getting taxed.
Yeah.
So the level playing field is yet to come as far as the taxation angle goes. Otherwise, ultimately, there are no major positives or major negatives otherwise from the regulator perspective.
Weber, you are typically not a long-only guy. So what are your thoughts on this?
See, I think clearly, while these guys are much more knowledgeable from a PMS perspective, but what I can say from an AIF perspective, of course, it gives you an ability to kind of go and leverage, okay, which is not possible from a vehicle like a mutual fund. Neither it is possible on a PMS platform as well. Now, how do you use that leverage? It depends upon your strategy, your risk profile, the amount of exposure you want to take, and so on and so forth, and depending on the objective of the strategy. But of course, that gives you a differentiated ability to deviate from your normal risk return curve, right? Which kind of gives you that advantage. Now, at the same time, the disadvantage when we talk about, and I would echo what Rajesh did mention and Mani said, is from a taxation perspective, okay, while PMS is at the receiving end as compared to the mutual fund, AIFs are actually at the much more of a receiving end than either of those vehicles, in the sense that AIF category 3, when we talk about, they do not have a pass-through system of taxation. Now, I can go into merits and debate about at length, but I can only say that it is absolutely a non-level playing field when we talk about AIFs as a vehicle, and especially on the category 3.
So just to make the panel interesting, if I want to play the devil's advocate, is it not a level playing field just because there is a taxation divergence, or the flexibility that the regulation provides to the boutique or the platforms is not being used appropriately by the managers? For example, let's say AIF Cat 3 gives you an opportunity to leverage. I have hardly come across any fund or manager who is using leverage, which is common across the globe, which can give you a added advantage as compared to the mainstream ones. But most of them are not using it. So the advantages that you are getting, you don't use, and just because of the platform, there are some certain taxation disadvantages which you highlight. Is it a fair comment on a comparative of regulatory advantages versus disadvantage?
Basically, as Vaibhav has said, there are three things now we are comparing: PMS, AIF, and mutual
So
fund.
this question was particularly for AIF.
So first of all, as far as PMS industry go, they cannot leverage.
Correct.
So there is no question of flexibility in
No
case
question.
of PMS.
Yes.
So argument ends over there. In case of AIF, India is still evolving. Please understand, our equity savings as a percentage of the total saving is still very, very, very low. Correct? Mutual fund in, industry is just like starting from last 5-6 years, now we are seeing increasing flow. Despite that kind of flow, our penetration is extremely low. So ability to understand the risk return side from the investor's perspective, it is also we are on that learning curve. Correct? As that appetite increases, I'm sure there are a number of products which will come out which will use that flexibility. But using flexibility for sake of using it is not the right way to do it. Right? So that's why, so it is not about flexibility. It is about, one is flexibility, that's on the fund management side. But after whatever returns you make, you need to consider what are the tax aspects. Just like we consider across various asset class. Right? So what we all are trying to say is that post whatever each fund manager does with this efficiently after using this strategy, the net returns to investors, after that how much tax each of structure has to pay.
Correct.
And that's where there is a level playing field is not yet there. That's what basically the one.
But then again, the point boils down to the tax inefficiency is being highlighted, but the flexibility that the regulation gives for whatever reason and rhyme, whether the capability of most of the fund managers is not there because that has not been the way people have managed money historically, or the clients are not maybe of that sort. But then when you are talking about boutique, you board the clients who are in sync with your style or this thing. So when you are not using the flexibility or the advantage that you have, but then highlighting the inefficiency is not kind of painting a fair picture of advantages that you have and disadvantages of a regulatory framework, right? Anyway, so coming to the PMS part.
Just add
Okay.
that last point here is basically that from a strategy perspective, right? I think we do use leverage very effectively. Okay. But one need to understand that the understanding of underlying risk of what you've told to an investor, what is it that you are taking, and your own understanding of when you're dealing in options and derivatives, right? Because we have seen that many of those strategies which are derivative focused and use leverage, there are many of them who keep on writing options, okay, and make money. Now, while you are doing that, in my limited capability of understanding risk, I can very well say that the methodology of calculating the leverage from a regulatory perspective and what you are promising to a client and the amount of risk you are taking is completely different.
Okay.
Okay. So it's not that people are not taking it, people are taking it, but one needs to understand from an investor's perspective, and that is why SEBI in certain way has given a minimum threshold of 1 crore to be invested in an AIF. So that the basic assumption is that the investor knows what he is probably getting into.
So if he has the money, he has the brains. So now coming to extending the same argument, let's say for a PMS platform where there is no stock level limit. So you can choose to take a higher exposure if you are so convinced or about the stock. But if you know of, I have not come across many strategies, but I have not seen any kind of a boutique style also taking a very high conviction 5-6 concentrated portfolio bet of 15-16%. So there is a flexibility, obviously it comes with its own risk, and that is where what Sandeep highlighted, that when the client is onboarded, he is in sync with that kind of a path. But again, that kind of flexibility has not been used much, has it been?
So again, it's individual managers' discretion.
Yeah, that is true. But
so
at
we
the
use
generic
it.
level.
We have fairly concentrated portfolios. We have situations sometimes that after buying a stock, when a stock starts to do well, it becomes a multi-bagger, and we want to back our winners all the way. So that one stock becomes sometimes even 18-20% of the portfolio for some
And
time.
mark to market allowed in mainstream also.
So that's what I'm saying, that those flexibilities each manager would use according to their strategy. That flexibility is there, but each one will use. I know of a manager who does 5 stock portfolios.
So, those are rare is what I'm saying.
Yeah, so
right?
but that's what the clients also don't want to take that kind of risk. So they would go to, so that's how it is. It's
okay.
really, you also have to know what you're good at, what your clients want,
Sure.
It's a matchmaking there, yeah.
So, after one or two questions, we'll come to specifics of individuals' approach and style. So, but just before that, the third word apart from the boutique and advantages was the alpha. So now again, alpha could mean different things for different people in the way you compare. For example, the way alpha could be defined by Vaibhav would be obviously completely different because he manages a long shot. Then again, because of the regulatory benchmarks and things like that, right? So, what according to you are various sources of alpha, and whether it is stock selection, sector selection, cash call, whatever, Manish, or you want to use some support in terms of
Oh, yeah, I
anything
have a
material?
presentation if you want, if you can put it across.
If you want to stand and take it through,
Oh, yeah, sure,
whatever
sure,
the way
sure,
you are
sure.
comfortable.
But just to roll the conversation ahead is, there's no one answer to alpha. Alpha, each one will define alpha differently, and there is a time duration which you will put on that in what time duration you are looking for an alpha point of view. And what is interesting is the source of alpha keeps on, sources of generating alpha keeps on changing over a period of time. Yeah. So if you have to look at how Berkshire Hathaway created alpha, was a very different way of looking at the businesses, and you had a very exceptional partners, a longevity of both of them for years and together, and one guy would go deep, one on one axis, and other one can go on different streams of reading thought process, and finally you are able to manage to generate an alpha, which is very different. So this was a way, a Berkshire Hathaway have generated alpha over years and years and together. So I had this interesting discussion with in one of the international conference that whether one guy can pull it out or not after the Charlie has left. And to me it looks like that, yeah, it's going to be tough because you had a very unique combination of generating alpha for maybe decades and decades altogether. So alpha means different people, different things. And to me, for maybe from a Berkshire Hathaway, which is known for creating alpha over the cycles, would be a very different way of looking at it. If I have to look at what is for us is, from an art style point of view, is the delta change. So what does that mean is that maybe you can generate an alpha from buying a 15 or maybe a 10% return on capital employed business, which is going to 15% return on capital employed, and you can lose money in a 30% return on capital employed business, which is incrementally going to 28, 29 or so. So it could be very different. Bigger sources of alpha for me and maybe for Valum would be sitting at the delta changes. And what does it mean also is that if I have to look at the sources of alpha, what has created alpha over a period of time, and if you have to look at the sources of alpha, those sources of alpha has changed. And I moved in industry in 1999, and at that point of time, knowing the management was a lot more important. Can you get a meeting with the management? And those were the days. And that has created NF alpha because there was a opaqueness of the information. So clear information arbitrage was there. And that got bridged, those information arbitrage got bridged by superior quality of the annual reports, which gave you a lot more inputs. And I think the Infosys in the IT sector became a bellwether in creating that. And that alpha was there till 2010 and 12. And so on and so forth. And 2012, if I have to look at broadly, even just I'm giving a broad context, the conference call, so I held a conference call when I was a sell-side analyst for a Grasim Industries, which would have been the first conference call in the history of Grasim, and it took me a long time to convince Grasim Industry to do a conference call. If my number serves me right, maybe last quarter there would have been some close to 700 conference calls, every quarterly conference calls. So a decade of time frame went into reading those conference call, understanding businesses for you to generate a superior alpha. What are the sources of alpha? And from there onwards, we have moved to the information explosion has moved to the technological, how fast you can harness those technology, and so on and so forth. And where are we now today for you to create a really source, a sustainable alpha? And that has happened in the developed market over a period of time. One is a behavioral edge for the manager themselves, and second thing is a duration edge. And duration edge is given to you by your clients, not by yourself. And as I said, and I refer to you, that when you're calling yourself boutique, it is not just a style of investing which is boutique. It is also the communication of your style to the clients, and you marrying your clients with that style of investing is also boutique in nature. And it is not a democratic system where a 5,000 rupees check, which could come from any part of PIN code of India and which would expect the same thing and will have the same outcomes. So it is a behavioral edge as well as the duration edge, which will create sustainable alpha as we go along in the future. From our style point of view, and as for this you were alluding, Kishore, too, is we look at growth at a reasonable price, and that is a style which has sustained. S&P runs a GARP index, and that GARP index has done reasonably well versus the growth indices or the other indices. So there is a style which is also very innate to a manager or to a style, to a firm and as a philosophy, and we ascribe ourselves to a growth at a reasonable price. So we will get priced out in a market which is full of momentum, or maybe themes which are full of momentum. And maybe if the deep cyclical values have to do significantly well, we will get priced out. So our operating machine is built on certain parameters, and it will do phenomenally well over a period of time under those certain parameters. So if you have to look at, these are the holdings where a GARP holdings is significantly different versus the other style of investing holdings. So it's quite distinct style of investing which generate these kind of alpha. So that's where we are, and I hope I was able to answer something what you had in your mind.
So I'll come to specifics
Sure.
regarding your style later.
Yes.
So as you highlighted, the differentiator or the alpha generators have also evolved, not just from a style point of view, but also the way the technology has moved, the way the transparency has moved, the way the information flow has moved, has also contributed a lot in terms of the sustainable alpha till now in history. Now, just a deviation, I mean, earlier also one of our global speaker was making this comment, and we all have observed these. As the market have developed globally, and US is definitely a stark example, most of the mainstreams funds have hardly outperformed. I mean, they have struggled to outperform, and the boutiques have kind of done a better job. Similar to, I mean, India still, the mainstreams are able to outperform, but in a particular large cap space, visibly it is seeming that it's becoming more and more challenging. So do you think the market construct has changed, which is leading to this phenomenon, and the boutiques also will kind of suffer to some extent going forward in the same league? Because in the same presentation, the global speaker highlighted, and she had done a study on Indian markets, the more the active risk taken, the alpha has been lower and lower actually. So that was one of the study that she kind of highlighted. I don't have any background information to that. So would you like to comment, Rajesh, on this
Maybe
aspect?
I can add one thing in this
Sure.
whole context. I'm not too sure what was presented today morning or so, but you have the patches of the market where most of us sitting on this side of the table would run a very focused strategies, 20, 25, and you alluded to a 5 or so. So you would have a market cycles which will be a supportive of those, and you will have a market cycle which was maybe till the first 9 months or 6 months or 9 months, where the breadth did significantly better than those focused strategies. So in that, someone else will have an advantage. Someone who's running a 50 stock portfolio would have a lot more advantage versus someone who's running a 7 stock or 10 stock portfolio. So this is also based on the construct of the market, and those construct of the market would define what is sitting at that point of time. So it is over a period of time, answer is yes, a superior strategy and a style of investing which has been in permanency would do well. But at a point of time, you can always get challenged because of the construct of the market at that point of time.
Raj?
No, so basically, if you ask my view, in any industry, and fund management industry is no different. Winners are always 5 to 10% in any industry. If you look at, for example, car industry, the top 6 players would be 75% market share. If you talk about two-wheeler industry, the top 4 players would be 78% market share. If you talk about bearing industry, the top 3 players will be 90% market share. Correct? So in any industry, the winners are always few. Correct? And that's true even globally. If you look at the big of the funds, And they keep saying active fund versus passive fund, active fund versus passive fund. And at times they say that number of active funds have reduced who are producing alpha has now reduced. But that's how it will be, am I right? The winners are always few. But it is all about going right of selecting that 5% managers we can give you 5% excess alpha on a compounded basis for 15 years. That's what makes a difference. Correct? People are talking about a passive funds. Now look at India. If you look at the active funds versus passive fund for last 10 years, I'm nothing wrong against passive funds. I'm talking about a pure Nifty, for example. For example. Because there are a number of passive funds within that, correct? I'm talking about pure Nifty, just to give an example. The active funds would have outperformed Nifty significantly, not over the last 5 years, 10 years, 15 years, 20 years, 25 years. Am I right? So it's all up to the manager, how he navigates those volatility. And of course, the winnering ratio always comes down. It is never like 98% of funds have outperformed. It never happens because if 98% outperforms the Nifty itself, return will be high. Please understand. Am I right? Because ultimately, there is a universe and there is a benchmark. So ultimately, the job of a fund manager is to how he can create superior alpha on a long-term basis, and winners are always will be few. Winners cannot be 100% of the universe. Winners will be always less than 10% of the universe. So that's fine, and that's how it should be.
So there is a common perception in the intermediaries, the mutual fund, may not be mutual fund, financial products distributors and investors in general buying and large. Is small cap a better wealth creator over a longer term, or capitalization is not a big or is not that big a factor in long term wealth creation? Sandeep? Though you are a small cap specialist, but you can give your unbiased.
So, no, my view will be biased. Okay, so, small caps by the very nature are more volatile, perceived to be a more risky universe. So they are supposed to give better returns over the long term. Else, why should one invest in small caps? So it's all about, then going about looking at, the small cap universe and picking the right companies. It's a misnomer that small caps remain small caps. Small caps grow. The good small caps become mid caps, they become large caps, and many also go into Nifty. So what if I told you in the last 15 years, from the current Nifty 55 companies were small caps.
So ultimately, for huge wealth creation, small cap will have to become a large cap.
So that is what I want to say, that the universe will always look risky because the winners have moved to the next level. But the newer winners will come from there only. So as a manager, it is my job then to look at which are the companies which probably and possibility have the potential to be the winner and move and jump the orbit. That's what creates alpha. But if you look at the universe, it will always look risky. That is my humble submission. I think people people invest to generate higher alpha with the expectation that I will make better returns with small caps. And that's what the duty of a fund manager is, to deliver that alpha. But how do you do it? Each one's style.
So Rajesh, if we have to talk about your core philosophy and approach of investing, like Manish talked about, the key message that I got is the delta of capital employed is kind of his focus area along with a gap overall style. So if we are to ask in terms of what is your core philosophy and approach of investing, and if you want to use any supporting.
But by the time they put it.
Yeah, it's already there.
I think, yeah, thanks. Warren Buffett says, rule number 1, never lose money. And rule number 2, never forget rule number 1. Correct? And that's basically what defines our investment philosophy. Protect capital and create wealth. And moment you say protect capital, create wealth, our entire investment approach and investment style is a little bit differentiated, which is called, Quagility. It is nothing but quality plus agility. Be quality conscious in what we buy and be agile enough to get out of it. Now, I'm sure there are thousands of books are written on how to buy the stocks, stock selection methodology, what to avoid, what not to avoid. But when to exit is equally important, if not more. Because India is an emerging economy and our GDP growth is 11-12% in nominal terms, being the fastest growing economy. Generally speaking, everybody thinks that every stock, whatever you buy, at least should give you 11% compounding because GDP grows 11%. Very clear, am I right? But the important is when to sell that stock. Because in between the stock can go up 10 times and that may lose again 75% from its peak. So if you don't exit, the profits are only on paper. So in terms of stock selection quality, we have something very interesting 3M approach. So if you just do next slide. Thank you. So that's basically our approach for stock selection, which is called very simple approach. Anybody who follows this approach, I can assure you will not lose money and hopefully will create wealth. It is a market size, market share, margin of safety. Buy companies where size of opportunity is huge. Buy companies provided companies market leader. And buy companies if the valuations are reasonable because price is what you pay and value is what you get. Now just connecting dot to your previous question on small cap, for example. Internally, we do not define companies based on market cap. We define companies based on net profit size. And that's something interesting because in India there are 5,000 listed companies and of that there are only 800 companies which makes net profit in excess of 100 crores. So 100 crores profit is a very important milestone because to get 100 crores profit you require 130 crores profit before tax and 200 crores of operating profit and 1,000 to 2,000 crores of revenue. So we salute any company which makes 100 crores plus profit. So that becomes our universe. But as per the regulation, only top 100 by market cap is called large cap. It means out of 800 companies, only 100 are large cap. It means 88% of that 800 companies are mid and small cap. But they are not small companies. Safari, for example, the second largest luggage player, is a large company but a small cap. Correct? Century Plywood, the India's largest plywood company, is small cap. Trent was small cap. Tata West Side was small cap when this regulation came into force. ABB was a mid cap. Hitachi Energy is a small cap. Sundaram Fastener is a small cap. TVS Motor is a small cap or mid cap. Phoenix Mall, the India's largest mall, was mid cap. TCI Express is mid. The entire hotel industry market cap combined was small cap when these norms were launched. But they were not small companies. And that's what's something important. Correct? So market size, market share, when you buy the companies which are oligopolies, and that's what we do, with a low leverage and high growth, that's basically become very, very important factor for us to do stock selection. And that's where the quality filters comes into play, that profit propellers and then the risk mitigators, they should be under leverage. And from there we select the stocks and the universe. And we are pioneer of 50 stocks portfolio in Indian PMS industry compared to most concentrated products which have been launched last so many years by the peer group. And still we delivered almost 15 times in 15 years. And once we buy, we monitor business cycles. And that's what fund managers are paid for. Because we cannot say, because there is not, the only constant is change. So if you look at, for example, there is a study in USA that average lifespan of a company is reduced from 90 years to 18 years. And this study is 8 years back, and by now probably is less than 5 years. So business cycles are changing fast. I still remember we bought one of the largest diagnostic company during COVID times. It became 2.5 times in less than 16 months. Thankfully we sold. After that it came back below our cost price. So only constant is change. The business cycles are extremely volatile. It's a volatile world. It's a VUCA world. Volatility, uncertainty, complexity and ambiguity. And therefore, as a manager, our job is to monitor the business cycles. We exit when we think the valuation is too fast, too soon. Or we exit when growth is slowing down. Or we exit when there is a better risk reward. Or we exit when we are going wrong, and we do go wrong, correct? And that's basically some very simple, concept. Ultimately, we all are predicting the earnings growth, and to that earnings growth with capital efficiency, which is called ROCE, we basically ascribe what valuation it deserves. Period. It's very simple. Irrespective of whether you use quant model, whether you use whatever model you want to use, growth, momentum, value, momentum, whatever. But ultimately, you are predicting EPS growth of the company at a particular return on capital employed, and you are deciding what valuation it deserves. And moment the valuation matrix is beyond either plus minus 2 standard deviation you need to take a call on buying bigger or exiting out of it. So it's a very simple strategy what we follow and keep doing it on a consistent basis. And that's what something important because only consistent about consistency is inconsistency. There is not a single sector in India which has delivered GDP plus profit growth every year for last 15 years. For example, Indian consumer sector, the most defensive sector, has underperformed GDP growth in terms of profit growth 55% of the time. It means 6 out of 13 years, it has failed to deliver 12% profit growth, which is India's GDP. India healthcare sector failed to deliver 12% plus profit growth 6 out of 10 years. So there is nothing called consistency, correct? And the pendulum of volatility results into the greed and fear, and Excel sheet people extrapolates, and that's the fantastic opportunity for active managers like us to capitalize on such opportunity, because people think specialty chemicals is like FMCG, and all of a sudden they're traded at 70, 80 P, and that's where we milk it out. Am I right? And sometimes people believe FMCG companies are commodity companies, and they go to the other pendulum in terms of fear, and that's where probably opportunity for the future to create alpha lies into it. So that's what we do.
So moving on to Vaibhav, so you don't have any dilemma of this sort, right? What is growth happening, whether it is low cap, small cap, mid cap. You are only concerned about what is the F&O universe, because short करने के लिए F&O का listed होना जरूरी है. So your universe has no complication. It is very well defined. So from there on, if you can share how you go about it, because in your case, the problems of the other people are not there. You have other problems to deal with.
That's the problem.
Yeah, so that is what I'm saying now. So here other problem to deal with. The first set of problem is already taken care of.
No, of course. I think, all due credit to the long only kind of strategies we have created.
Which allows you to
Immense
short
amount
them.
of wealth. What the long only managers cannot do is something which we can do. And probably that's our strength in that sense. Of course, as you rightly mentioned, that the universe has to be largely the F&O space or the derivative space. But let me take a step back from a strategy perspective, and when we talk about long short as a philosophy. Long short as a philosophy only enables you or gives you an opportunity to kind of hedge your portfolios or take a position against the normal market, which is a long only market. Now when you use this ability of going short on the portfolio, and depending upon how much do you want to do, how much net exposure you want to take, and so on and so forth, it gives you a deviation from your normal risk return curve, which I alluded a little earlier as well. For us, long short is just a tool to manufacture strategies which are extremely conservative to very, very aggressive as well. Now what do I mean by that? Is when we talk about long short and when we talk about an conservative strategy, then there I am actually pitching my strategy or the output of my strategy as against your fixed income. Even though I am actually trading into equities as an asset class, the risk return profile of that strategy is very akin to a debt kind of instrument. Similarly, when I am manufacturing a strategy which is an index plus strategy, there I am competing against a large cap product or an equities as an asset class where my intention would be to generate returns which are equity plus, and from a risk perspective which are equity minus. All these things are only possible because of what you can do under a long short umbrella. Let me take an analogy both from a cricketing analogy or an accounting analogy in this sense, from a long short as a vehicle perspective. When we talk about cricket, you have different forms of cricket, which is your T20, your one-day cricket and a test match. And you have different geographies, including your India, when, in a T20 match is an absolute flat pitch. Everybody can do the average player can do a 4 and a 6. So in a bullish market, people can make money irrespective, whether somebody knows, doesn't know, and so on and so forth. Whereas the same player, if he goes to an overcast condition in England or in New Zealand, it's extremely
Or
difficult to
Australia,
survive.
as
Or
we saw
Australia.
recently.
So the point is that there the conditions has to support. So in a normal long only strategy, the underlying portfolio return, whether we like it or not, is also a factor of the direction of a market on an overall basis. Okay? No matter how good I am a stock picker in the market, okay? Ultimately, the market has to support me in a certain way for me to deliver that kind of return from an absolute perspective. For us, we're an all-rounder player in that sense. We play on a T20 match, we play in a one day, we play in test match, and we play across pitches. Point being that our flexibility in our approach from a long-short perspective helps us to deliver that kind of alpha on a consistent basis with respect to the asset class which we are mentioning. So that's one. And second, analogy is from an accounting perspective, when we can say, let's consider markets as an asset or a liability in that sense. In a bullish market, the market kind of turns to be an asset for the portfolios in a long-only markets. Whereas in a bearish market, the same turns to be a liability as well, irrespective of your stock selection, which I mentioned. Now, for us, it's always an asset, purely because whether the market goes up or goes down, our ability to do short and long both kind of helps us. But of course, while you do have that flexibility, along comes with that responsibility also of being extremely disciplined in terms of your approach. So both are kind of hand in hand, and an ability, as I said, to kind of generate that risk-adjusted returns.
So we have kept Sandeep silent for a long time. But before we get into your core philosophy of approach, I just like to dither a bit and take up another topic which is more business oriented, because you all are not just investment professional but the founders of your business as well. So in a boutique, in your assessment, how challenging is to attract and retain good quality human resource, given there are other big mainstream players who may be equally vying? And as in the last presentation, Srini was just mentioning that not doing any deal and people were getting restless and changing jobs. So in a boutique firm, by definition, though you all have defined that, but typically we understand that it's a smaller team per se, right? So within that, I mean, there would be retention and good quality recruitment challenges. So Sandeep, your thoughts on it, and then maybe we'll quickly move the same questions.
Yeah, so Kishore, you're right that when it comes to attracting talent, we have to be very, very mindful of the fact that we are small. So the only thing that we can sell to an aspiring candidate who we want, who we like and who we want to be a part of our team is the vision that we have for us as well as for the candidate, what kind of a career progression. So here, the big difference is that you can give a career progression path, which both in terms of the roles and responsibility as well as in terms of connected to that, the compensation, the path can be possibly fast forwarded to a level where there is both professional satisfaction as well as financially one should feel happy about what can happen. So that I think is one of the important communication points when we look for hiring a new talent. The second important thing is also trying to bring coherence with the potential candidate about what your philosophy is in terms of the investment philosophy, because that's very important. As I said somewhere in the beginning, that ours is a very boring job. We invest and we sit on our investment for five years. So somebody who comes with a very, very, trading mindset that, you want to pick winners and get in and get out, possibly will not like the work environment that we have. While on the flip side, somebody who enjoys long-term investing would feel very comfortable. So I think those are the things which matter a lot. And then once a person is a part of the team, then it's all about delivering what you promised. So what you promise, if you deliver, we've seen that. I've been fortunate that we've had colleagues who've stayed for very, very long. And even when they have left us, they've left us on very good terms, and they are our brand ambassadors.
Manish, same.
So,
If anything different to add?
yeah, sure. I think close to 700 hedge funds closes in US each year. And it's a highly skillful an entrepreneurial journey. So one of the reasons why many of these hedge fund closes, and I did look at it more carefully when I started my entrepreneurial journey, was related to not that those were not good stock pickers and they generated less return also because as a founder of the firms, you are also a CEO of the firms, and you are using a lot of your managerial bandwidth. I can be one of the very good portfolio manager, very good fund manager in my erstwhile areas and a stock picker, but I may not be a good manager. So how do you define your team? How would you structure your team? Makes a lot of difference, and that will define the success of the firms. It's not just the returns. So how do you define your teams is a very integral part. Maybe at Valem, we don't dissect things on the sector basis, on the competence basis. So someone is maybe very good in understanding modes. His job is to, like a McDonald's kitchen, he has to do one area, getting the modes, someone else has to take it forward. And that gives a lot of creative expression to the people who wants to do something which they are very skilled at. And they don't need to do something which you are not skilled at. And you feel quite happy about it when you're doing something what you're skilled at.
Rajesh?
Yeah.
Well, I think, something very important is what boutique managers offers to, first of all, this is a challenge not only for boutique or finance, I think the entire India. If you ask, like every day, whenever, on an average, we meet 3 companies a day, correct? And whenever you ask any company, what do you think the challenge over next 5 years? He said the unemployment in India on one side looks very high, but the employability of the people to whom you would like to recruit is always a shortage. So good people are always shortage. So I think this challenge across India faces, because India is a growth phase. So this is a very natural challenge. Yeah, having said that, I think the biggest important thing at our firm, and I'm sure for any firm, the USP is your team culture. You need to have the right culture, number 1. Number 2, the empowerment. And number 3, for boutique firms like us, the entrepreneurship mindset. That is something critical, because ultimately we are investing into the businesses. It's a 24/7, and I always say to any candidate that if you are thinking you are coming for a job, then this is not a right firm. It should be your hobby. If it is your hobby, then welcome to this. And you are getting paid for that hobby, correct? So we are very fortunate that we are in a field that actually is our passion, is our hobby, and we are getting paid for it. And that's something very important. What you can offer is a right team culture, number 1. The more empowerment, number 2, being a small team. Because I have seen, for example, one of my friend is in, Europe, and he's looking after FMCG sector, consumer sector. He's tracking Unilever for last 36 years. And he's tracking only 7 companies. Only 7 companies, correct? So that's what happens when you are a very big fund, with a 200 analyst team. You know your sector is not going to do well, but you don't have any choice. You need to keep tracking the same companies. Whereas if you have a small team, 5, 7, 8, 9, 10 members, depending upon your size, you can have a multiple responsibility, number 1. Multiple sector allows you to think and wire differently, because you can do cross-sector studies, and so many much more. So it is your own दुकान, अपना दुकान है.
Correct.
और अपना दुकान में काम करने की मजा अलग होती है. Correct? So that's what the difference.
See, I think from an HR or a resources perspective, of course, people would want to have that passion, as what kind of Rajesh mentioned. But the right mindset with that integrity, are the key kind of, attributes which we look for generally. Having said that, we are extremely careful to add any kind of additional team member to on our team purely because it has to fit the right approach, right size, right mindset, and so on and so forth. And which is why what we have seen is from our business perspective, my core team has been together for last 15 years. And there has not been any sizable churn from a team perspective purely because they associate themselves with that style, that dynamism, and something at the end of the day you are adding value to a client's kind of portfolio.
Got it.
In the meantime, of course, you get paid. That's a different matter because at the end of it, everybody is working for getting paid. So you need to pay them for sure, but that's not the only attribute I would say.
So we saw 3 of our panelists' style of investing that they took us through. Sandeep has always been very clear in terms of his core focus area of small cap. So I have kept it for the last in terms of the way he would like to take us through his core philosophy of investing. Like the common adage goes, chota packet bada dhamaka. So Sandeep, would like to listen to how you approach things and if you want to use any support in terms of, yeah.
Yeah, so yes, the core objective of our investment is to generate long-term alpha, and our long-term is really long-term. We stay invested in stocks for 5+ years, and what we say is that our success mantra is we basically bring in the private equity approach to stock picking, and then we combine that with what we call as our Guardrails framework to buy and construct portfolios as well as exit. As Rajesh said, exit is very important. So there is a method to the madness when we also plan our exits. Okay, sorry. So what is it that the private equity approach entails? A lot was already spoken about. It all starts with a good solid business and a good solid thesis. We typically look at structural tailwinds which will allow a business to grow. As you know that no business can continue to grow forever. You need to see which is pick the business at the right early in the cycle, and that cycle should play out over the next 5-6 years is what we look for, and that needs to be aided by structural tailwinds. Obviously there could be non-linear earning triggers which we like and which we appreciate. That adds to the entire flavor. Our goal is to capture the discovery premium, so look at it early. Just to give you an example, we were pretty bullish on capital goods 4 years ago. So post-COVID, when nobody really spoke about capital goods was a no-no. Nobody would touch capital goods by a barge pole. We liked capital goods, and the reason for that was we really felt that now because of the China +1 that is likely to play out, China was being shunned by the world. So this is the time when over the last many years Indian companies have tightened their belts, have done whatever debottlenecking. So they are at their most efficient phase with strong balance sheets. But the coming times when there is a capex cycle pickup, these companies are going to do very well. And that's how we went with that thesis, and we bought companies like Praj and companies like Anup Engineering, and they have become multi-baggers. So that's the private equity thinking at work, which we kind of do on a day-to-day basis. Our ideation, I would say, is one of our strong strengths of structural trends and where we should be investing. The Guardrails framework basically is all about basically looking at a company and kind of analyzing the company with this respect to what the management stands for, what the leadership stands for, what kind of a business attractiveness the business offers, and then finally looking at the financial attractiveness, which obviously includes valuations. We do not follow a model portfolio strategy. So, we may be, holding a company and that company is doing very well, trading richly today. We are not selling today, but we are not buying that company for clients either. For us, the fundamental principle is returns are a function of the price you pay to buy an asset. You should buy asset at reasonable prices. So that's what we do. For every stock that we buy, there is a guardrail price which comes, and the guardrail price comes through this whole scoring framework that we have, where we basically create a score for every company and say that what is a reasonable, price to pay to buy this company with the anticipation of making our targeted returns. And that's the same thing that also happens when we sell. We carry the conviction, we hold it for the long term. If there are, medium term issues or which we feel are likely to impact, we may even, take corrective action by selling early or selling in part when the markets are in a mad bull run. But the whole philosophy remains that we want to play the entire cycle and then we want to exit. So we invest to exit. That's a part of our strategy. We do not remain invested forever in a business, no matter how much we like the business. So that's essentially what we do. And as I said, Anup Engineering was a great example, bought post-COVID, and it's done really well. This is just an illustration. We have several such stories to say, So that's about the philosophy that we have.
I think there's a red board which is saying thumbs up to me, or it's time's up actually, but I will take a couple of minutes more. So as you all pointed out that given the boutique nature definition, you are married to a particular style and believe in that thesis and style, and you are well aware that it would not work in patches of market, as Manish was rightly alluding to, that if it is a momentum based market, Manish may not do well in that patch, right? So similarly, you all are kind of aware in which patch you may not do well. So, but at the same time, you are taking a call from a long-term investing part. So is there a conundrum that you face, or do you practice taking cash calls or communicating that this is a patch where we are not going to do well, so take your call to investors, or things like that? How do you go about that? So the shorter question is, how do you go about the strategy of taking any cash call or no, and how do you view that? All of you.
Yeah, of course. So
In
I think
15 seconds
very
each.
simple. I think what we can say is basically that we are paid for taking cash calls in that sense. So when the risk is extremely elevated, we have gone as high as 98% cash into the portfolios, which you will not find any conventional kind of manager would have the ability to do that. So that is something we are supposed to, and we do, often take it. That's part of my job, I would say.
Manish?
So I don't believe in cash calls. You have a client who has allocated a capital to you. Your job is to deploy that money. In intermediate period, it could be a very short span of time, but it's a very active call what you are taking as an asset allocation. Cash call is not a cash call, it's an active asset allocation call.
Yeah.
That's not our job. We have to define very clearly our job. Tomorrow's multi-bagger is getting made today. Your job is to go and find it. That's all.
Rajesh?
We have seen that across the time periods, if you run the rolling returns, roughly 33% of the universe of BSE 500 stocks can give you 20% plus compounding returns with a 3-year rolling returns, by and large, irrespective of what kind of market you are. So as I said, you need to exit where you think there is a valuation which are beyond justifiable, and then you need to enter because at any given point of time, there are always sectors and stocks where people are fearful.
So you don't believe in cash call?
You cash out and cash in somewhere.
No, but that is portfolio rebalance.
Absolutely.
That is not a cash call.
Yeah, absolutely.
Sandeep?
We don't take cash calls. Our guardrails decide which client stays how much in cash because stocks are not available. There is no portfolio level cash call that we take.
So all the 3 long only managers who each have about 12 to 15 years of track record in their own boutique firm, apart from the mainstream fund, the sources of alpha mostly have been through stock picking, selector selection, rather than any cash call per se. Is that a fair statement?
Yeah.
So with that, I think we'll call it a day, and thank you all the 4 panelists for a very, very insightful, transparent, and there was not much heated discussion, but yeah, I mean, very, very invigorating session. Yeah, obviously, I mean, to kind of, you know. So with that, over to the MC.
Thank you so much, all of you, for taking the time on a Sunday evening and joining us. Thanks a lot. It was a really nice session. I would just like to call upon Shamit, Vijay, and Mr. Sanjay. All of them are the directors of our CFA Society, to please hand over some mementos and our token of appreciation.